The most powerful force in the silver market right now is not a government. It is not a central bank. It is not a hedge fund. It is a structural shift that has already happened, and almost nobody outside of a very small circle knows what it means yet. But you are about to. Welcome to SHF Money. If you are new here, hit subscribe right now and drop a like on this video, because what we are about to walk through is the kind of information that changes how you see the entire precious metals market. This is not a prediction. This is a pattern that is already triggered. And the window to act is shorter than most people realize. Let me show you exactly what happened. On Friday, February 21st, 2026, silver closed at 108.75. That number alone tells you nothing. What tells you everything is what happened inside that final hour of trading. Silver broke through a moving average. It had been rejected from every single day for 2 full weeks. Every attempt, every rally, every push higher got slapped back down at the same ceiling. Until Friday. Friday, silver closed above it. That is a technical breakout. And in isolation, a technical breakout is just a chart event. But this is not isolation. This breakout happened alongside 5 other signals firing at the same time. And when 6 signals fire together, that is not noise. That is a message. Let me walk you through every single one so you understand exactly what you're looking at. The first signal is the technical breakout itself. Silver spent 14 consecutive trading days closing below its 21-day exponential moving average. Every single day, buyers would push price up toward that level, and sellers would hammer it back down. That kind of repeated rejection builds resistance in the market's memory. Everyone watching saw that ceiling. Traders positioned around it. Algorithms tracked it. And then, on Friday, in the final 13 minutes of the session, over 4,800 contracts traded. That is roughly 24 million ounces of silver changing hands in less than a quarter of an hour. That volume spike pushed silver above the 21-day exponential moving average. And it held. Silver closed at 108.75, sitting 0.47 above that average. The ceiling became the floor. That is what a real breakout looks like. Now here is why the number matters beyond the chart. Over the last 15 years, when silver closes above its 21-day exponential moving average after spending 10 or more consecutive trading days below it, it has rallied an average of 8.7% over the following 15 trading days. Not always, not guaranteed. But 8.7% is the historical average outcome of this exact setup. Apply that to 108.75, and you get to 118.20 by mid-March. That is the conservative target. And we have 5 more signals that suggest this move goes far beyond conservative. The second signal is the Commitment of Traders report published by the CFTC on Friday, February 21st, 2026. This is where the smart money leaves fingerprints. Commercial traders, the mining companies, the industrial silver users, the banks that actually touch physical metal, they reduced their net short position by 14,200 contracts in the week ending February 18th. That is the largest single-week reduction in commercial short positions since September 2024. Think about what that means. These are the most informed participants in the silver market. They live inside this market every day. When they reduce bets against silver, it is not because they are bored. It is because they see higher prices coming and they do not want to be caught short. At the same time, managed money, the speculators, the hedge funds, the trend followers, they added 9,800 contracts to their long positions in the same week. Both groups moving in the same direction at the same time. Smart money covering shorts, speculative money adding longs. The last time we saw this exact alignment was October 2024. Silver was at $83. 6 weeks later, it was at $106. That is a 28% move in 42 days. The positioning looks identical right now. The third signal is happening at the retail counter, and it is impossible to fake. Physical silver premiums are exploding. American Silver Eagles at SD Bullion, as of Saturday morning, February 22nd, 2026, are priced at $138.95. That is a 30.20 premium over Friday's spot close of 108.75. APMEX is showing Eagles at 130.50. JM Bullion has limited inventory with Eagles at 137.85. Money Metals is showing 140.20. 4 major U.S. dealers, all showing premiums above $30 per ounce. Now here is what that tells you. When the price you actually pay to hold a silver coin is $38 more than the price quoted on the exchange, there is a physical shortage. The paper price has not caught up to what real silver actually costs in the real world. And historically, when retail premiums stay above $28 for more than 5 consecutive trading days, silver spot price rallies 87% of the time within the following 30 days. We are at day 7 of elevated premiums above $28. In March 2020, premiums stayed above $28 for 12 days. Silver went from $14 to $24 in the following 60 days. In January 2021, premium stayed elevated for 9 days. Silver moved from $25 to $29 in the following 3 weeks. The physical market is screaming that paper price is wrong. And when paper price corrects toward physical reality, it moves fast. The fourth signal is U.S. mint sales data, published February 20th, 2026. Silver Eagle sales for February have already reached 3.84 million ounces in just 20 days. That puts February on pace to exceed 5.5 million ounces for the full month. The last time monthly Silver Eagle sales crossed 5.5 million ounces was January 2021. You know what followed January 2021. Silver spiked from $25 to $29 in 3 weeks as retail buying triggered institutional attention, because that is how the cycle works. When regular people start buying silver aggressively, institutions notice. And institutions do not like being late to a move, so they start positioning. And positioning by institutions is already showing up in filings. Sprott Physical Silver Trust added 1.8 million ounces in the week ending February 21st. That is almost $200 million at current prices. VanEck increased holdings in their Silver Miners ETF by 12%. Jupiter Asset Management disclosed purchases of 900,000 ounces. These are not retail investors buying 1-ounce coins. These are allocations of $50 million, $100 million, $200 million from institutions that do serious research before they move. They are already positioned. The fifth signal is the one that separates this moment from every other rally attempt in recent memory. COMEX registered silver inventory is draining faster than any time since January 2021. On January 31st, 2026, registered silver in COMEX vaults stood at 31.8 million ounces. As of February 21st, it stands at 27.1 million ounces. That is a 14.8% decline in 21 days. Traders are pulling physical silver out of the exchange system at an accelerating pace, and here is what is standing for delivery in March. 6,114 contracts representing 305 million ounces of silver are standing for March delivery. COMEX has 27.1 million ounces registered. That gap between what is demanded and what is available is not a typo. Historically, only 5 to 8% of contracts stand for actual delivery. Right now, 22.7% are standing. That is nearly triple the historical norm. If even 20% of those standing contracts demand physical, the math breaks. There is not enough silver in the registered vaults to meet that demand. That is a squeeze setting up in plain sight. And when silver squeezes, it does not drift higher. It moves violently. The delivery window is March 1st through March 31st. This is not a future risk. This is a present reality. The sixth signal is the gold-silver ratio. Friday's close put gold at $2,930 and silver at 108.75. That gives a ratio of 26.95 to 1. For the last 15 months, this ratio had been trading between 27.5 and 29. Silver was underperforming gold consistently. This week, the ratio broke below 27 for the first time since October 2024. That is a regime change signal. Either gold is about to weaken or silver is about to outperform dramatically. Gold is not weakening. Gold is making new all-time highs. So the ratio move means one thing. Silver is beginning to outperform. Historically, when the gold-silver ratio breaks below 27 after spending months above it, silver outperforms gold by 15 to 25% over the following 90 days. If gold stays where it is and silver outperforms by 20%, silver goes to 130. If gold continues rising to 3,100 and silver closes the gap, silver reaches 138 or higher. The ratio is broken. The catch-up trade has started. Now let us talk about where this goes and how to think about it. The first target is 118. That is the historical average outcome of the 21-day EMA breakout pattern with a 75% probability of reaching it by mid-March. The second target is 127. That is based on Fibonacci extension levels from the October 2024 rally. 60% probability by late March. The third target is 140. That is based on the COMEX delivery squeeze, forcing paper price toward physical reality. 45% probability by end of April. The fourth target is 175. That is based on the gold-silver ratio normalizing to 18 to 1 with gold continuing its upward trajectory. 30% probability by end of June. 4 targets, each supported by a different mechanism, each supported by data already visible right now. Now here's the part most people get wrong. They see a setup like this, and they make the right move, they get positioned, and then they get shaken out during the first pullback. So let me tell you exactly what that pullback is going to feel like so you recognize it when it comes. Silver will rally to 115, maybe 118. It will feel incredible. And then one morning, you will wake up and it will be at 109, and your stomach will drop. The breakout is failing. I should sell. No. A 7% pullback inside an uptrend is not a failure. It is a reset. It is how bull markets shake out the people who do not really believe in the trade. As long as silver holds above 105, the 50-day moving average, the structure is intact. Pullbacks to 107 and 108 are not exits. They are entries. After that pullback, silver will consolidate. It will trade sideways between 116 and 121 for 1 to 2 weeks. Every day you will check the price. Every day it will be the same. You will tell yourself the rally is over. It is not. Consolidation is how bull markets build energy for the next leg. The move from 118 to 135 starts from that plateau, but only for the people patient enough to stay. Then silver will hit 120, maybe 125, and if you bought at 95 or 100, you will be up 20 to 25%. You will want to sell it all and lock in the gain. Instead of selling everything, consider selling 20 to 30%. Take some profit. Reduce your risk, but keep the majority of your position intact for the full move. Selling everything at 120 on a trade that goes to 175 is a decision you will remember for years, not proudly. Now, let us zoom out to the supply and demand picture because this is what makes the macro case unbreakable. According to the Silver Institute's World Silver Survey published February 19, 2026, global silver supply in 2024 was 1.04 billion ounces. Total demand was 1.19 billion ounces, a deficit of 150 million ounces. And that deficit is growing. Solar panel manufacturing consumed 194 million ounces in 2024, up 18% from the year before. It is projected to grow another 20% this year. That is 39 million more ounces of demand from solar alone. Electric vehicles consumed 67 million ounces in 2024, up 23%, projected to grow another 25%. AI data centers consumed 41 million ounces, up 38%, projected to grow 40%. 3 sectors adding 72 million ounces of new demand in a single year, and mine production is only growing 2%, 17 million new ounces of supply against 72 million new ounces of demand. The gap does not close, it widens. And it will keep widening because 70% of silver comes as a byproduct of copper, zinc, and lead mining. You cannot just decide to mine more silver, you have to mine more copper first. And new copper mines take 7 to 10 years to build. There is no short-term supply response to higher silver prices. Higher prices just mean wider margins for the miners who already exist. The supply cannot save this situation. Only demand destruction could. And demand for silver in solar panels, EVs, and AI infrastructure is not going to slow down. Those are the secular trends of the next decade. Silver is in all of them with no substitute. In India, silver import duties were cut from 15 to 6% on February 12, 2026. Indian imports are projected to increase 30% in 2026. That is 60 to 70 million additional ounces from one country. The silver market does not have 60 million spare ounces sitting around. The setup is real. The signals are confirmed. The macro story has not changed. It has accelerated. You have been holding through the consolidation. You bought when others were not paying attention. You sat through the sideways months and the moments of doubt. This is the payoff moment, not because someone told you to believe in silver, but because 6 independent signals all just confirmed the same thing at the same time. Technical breakout confirmed. Smart money repositioning confirmed. Physical premiums elevated for a week confirmed. Mint sales at multi-year highs confirmed. COMEX inventory draining at the fastest pace in years confirmed. Gold-silver ratio breaking critical support confirmed. All 6, all at once. All pointing the same direction. The wealth transfer in this market has already started. The only question is whether you are on the right side of it, not whether to believe in silver. You already believe. The question is whether you will hold through the volatility that comes with every major move, whether you will recognize pullbacks as opportunities instead of exits, whether you will trust the data when your emotions are telling you to run. Data does not make you money. Execution does. And execution in a bull market means one thing: hold the position. If you got value from this breakdown, share it with someone who is watching silver but does not have this information. Most people will sell at 118 and watch the move to 142 without them. Help them see the bigger picture. Subscribe to SHF Money for ongoing updates throughout this rally. We will track every signal, every move, every shift in the data, so you are never navigating this alone. Drop a comment below right now. Tell me the breakout is here. Tell me your position, your conviction, where you think this ends. The people watching this video are not passive observers. They are positioned, and they are paying attention. Stay sharp.